Welcome to the Wealth Renegade podcast. I'm your host, Robby Butler. Have you celebrated your financial independence today? Welcome to this special edition of the Wealth Renegade podcast. Some of you know that the work I do for Y Street Capital as their Director of Capital Markets and Investor Relations brings me into contact with some incredible investors. This specific conversation was done under that umbrella with Y Street Capital's senior partner, Victor Menasce. We did an online LinkedIn Live recording calculating and assessing some of Victor's predictions and what he describes as his deductive reasoning of what will happen in macroeconomics, in personal finance, in the world economy over the next period of time. Enjoy this very special episode of the Wealth Renegade podcast. Welcome, everyone. We are thrilled to have you on this streaming session with our host, Victor Menasce, the co-host of the Real Estate Espresso podcast. We're so excited to have you, Victor.
Well, great to be here. We're going to be talking about making some predictions, and predictions have this quality to them. It's almost a mystical quality. People think that you're seeing into the future, staring into a crystal ball. And maybe that's a little bit of a misnomer, maybe not the right way to think about it. I think of this more like deductive reasoning, because if you can see things that are highly connected in the marketplace and you can just use very simple deductive reasoning, then they're not really predictions per se. You're not making a giant leap of faith or a leap of logic. You're just applying deductive reasoning. And frankly, that's all that I do. You know, we are now 2,300 episodes on the Real Estate Espresso podcast, and we've gone through an experience where repeatedly I will talk about something on the show and then read about it weeks later, 3 weeks, sometimes 6 weeks later in the Wall Street Journal. And it's, again, I'm not doing anything particularly magical. I'm just paying attention to what's happening in the marketplace, which means that if you're paying attention, you can do this too. Anyone who's listening to this live stream, and we are streaming now, in fact, on multiple different platforms. We are on LinkedIn Live, we're streaming to YouTube, we're streaming to Facebook. And so it'll be available as a replay on all of those platforms. As well, if I do a good job, this might even appear as an episode on the Real Estate Espresso podcast. So we're going to be really talking about deductive reasoning. And so I'm excited to have this conversation today.
Is there something that you feel has launched you forward to be a better predictor as the years have turned and you've done more study along these lines?
I think there are things that are highly correlated in the marketplace. And we know that certain economic metrics are manipulated. We know that the Bureau of Labor and Statistics and the BEA, they will tell you what those manipulations are. They don't call it that, of course. They call them adjustments or seasonal adjustments, all kinds of different adjustments, and they will show you the math. But that math doesn't necessarily apply to every single metric. I'll give you a simple example. You'll hear a politician stand up at the podium and talk about how strong gross domestic product is. The economy's doing great. But if you actually look at the underlying data, what you'll find is that gross domestic product and gross domestic income, those two numbers, if they're accurate, both those numbers actually do track each other almost perfectly. You can overlay those two graphs, hold them up to the light, and they should overlay almost perfectly. We've seen over the last 2 years a divergence between gross domestic product and gross domestic income. So when I see that happen, not just for a quarter or two, when it's really persisting and I'm seeing these two graphs diverge, it's not a giant leap of logic to say one of these two numbers is wrong. Which one of them is manipulated? Which one has all kinds of adjustments to them and which one doesn't? Well, now we know that GDP is probably incorrect because gross domestic income is tracking significantly below GDP right now. And it's been, those two graphs have been diverging now for the better part of almost 2 years. So one of those numbers is wrong. And again, I'm not doing anything particularly magical. I'm simply looking at what's happening in the marketplace and applying very simple deductive reasoning.
Very cool. So for those of us live and in person right now, is there a place to begin when you are doing any assessment of either geopolitics or economics or macroeconomics? Is there a place you always go back to say, okay, this is my starting place and I'm going to reason down to whatever subject it might be that you're pursuing at the moment?
You will often hear in the headlines what are called, well, statistics that are, manufacturing indices and confidence indices. These are soft metrics. They're based on sentiment as opposed to being based on actual hard data. I tend to put a little less emphasis on those. Yes, sentiment is important, but it's really hard data that matters. So I tend to look more at the hard data and I look for things that should be highly correlated. So for example, if people say, well, construction is booming, then I want to look at supply and demand, both of those sides of the equation. I want to see what's happening with particular commodity prices. So, for example, if lumber prices are increasing, what is driving that? Is it demand driven? Is it supply driven? Is it both? Really, to understand those market dynamics. Be looking at copper. You could be looking at oil consumption. One of the things we know is that for every unit of economic output, there's an equivalent unit of energy consumed somewhere in the world. So if everyone says, well, the global economy is growing, but yet consumption of oil is falling and supply of oil is falling and prices of oil is falling, well, something doesn't add up. It's just not adding up. And so I dig deeper into that. And it's an opportunity to say, something's not adding up. What is missing here? And you become a little bit of a sleuth to try and figure out where things aren't adding up anymore. And that's all I do.
We've already got some pre-submitted questions and some questions coming in live. And so seeing those, is there a place you want to begin this evening with sharing some predictions you have?
Absolutely. Absolutely. So the first thing that I'm going to start with is international currency markets. We have seen the US dollar rising over the last several weeks, and I'm going to predict that it is going to continue to rise over the next 6 months. Now, that sounds like a prediction. But again, I want to go back to this is deductive reasoning. So I started my career as a hardware engineer designing microchips and did a lot of software development. And when you're writing a piece of software, there's a very basic construct in any programming language called the if then else clause. And so it's very simple. If rain, then umbrella. Those two kind of go together. You can figure that out. If snow, then shovel. We don't have to go too fancy here. And so I'm applying that same basic thought process. So if the European Central Bank is dropping interest rates and the US is holding interest rates steady, it stands to reason that you're going to see money flow out of the euro into the US dollar in search of yield. ECB bonds are going to be similar grade, similar quality to Federal Reserve notes. And so those are going to be sought after by folks that are looking for absolute safety. If they can get higher yield in US dollars than they can get in euro bonds, they will migrate to US dollars at a certain point. So we are already starting to see the US dollar rise. It's risen sharply against the Japanese yen. The Japanese central bank spoke loudly about how they were going to defend the yen. And then in the last couple of weeks, they've done absolutely nothing. So the yen has fallen quite precipitously against the US dollar. We're seeing the same thing against a number of major European currencies. We're seeing it against the British pound. We're seeing it against the Turkish lira. We're seeing it against the Chinese renminbi. We're seeing it across a number of different currencies. And I predict that is going to continue. And if you know that is happening, what would you do differently with that knowledge? And we'll get to that when we get a little bit further into some of the other effects that are going on here. But just remember, if the US dollar is rising, what would you do with that information if you were looking to make money? And I'm not just talking about speculating on currency. I'm talking about if there are things that you need for your projects, where would you buy them in the world and how would you buy them in order to take maximum advantage of the rising US dollar? Those are some of the things that go into our thought process.
Fascinating. Again, our questions coming in do align with this, but maybe we'll save some of the input questions for later. And yet hearing what you're describing, is there an end that you typically take your reasoning to? Do you say, okay, I'm not going to try and make predictions or deductions beyond 5 years, beyond 10 years? Is there a timeline that you constrain yourself to?
I'm not looking too far out into the future. I would say that if we think about the construct of the podcast, it's pretty straightforward. My thesis is that if I give you, the listener to the show, 10 things to remember, you're not going to remember any of it. So if you're an avid listener to the show and you listen to what I do pretty much on a daily basis, I give you one thing to think about every day. one concept, one central idea. And I'll go deep on that and stop. And then it's difficult in a 5-minute segment to play out a full 10-year forecast. I'm really looking 3 to 12 months into the future. Probably not, because not too much further than that, because now you're starting to look over the horizon and you can't really see over the horizon, but you can see a little bit into the future. And that's the nature of the types of predictions I tend to focus on, because again, I don't want to be predicting. I really want to be using deductive reasoning more than anything else.
Very cool. For those who aren't familiar, Victor's Real Estate Espresso podcast is available on all those listening platforms, and it is 5 minutes a day, focusing on one single element. Some of the things that we're discussing today are obvious outgrowths of that research that you've done, Victor. So, where to go from here? What would be another prediction you'd make?
So let's look at what's happened over the last year. If you go back to 2022, China was doing about 6.5 million housing starts, 6.5 million completions a year. It's a fair bit of volume. It's more than double, more than triple, my goodness. The US at the peak in 2006, last year, the US was around 1.5 million completions, which was almost a record recovery since the GFC that started in 2008. So 6.5 million homes, and it's really come to a screeching halt. China is over with housing right now. Some estimates put that oversupply as many as 30 million homes. There are major suppliers in China that have been serving their domestic market. They've also been serving Home Depot and Lowe's as well. They've been serving their domestic market. It doesn't take a giant leap of logic to say those suppliers are in search now of new markets, of new customers. That's obvious deductive reasoning. So, for example, one of the suppliers that we work with is a Chinese company called Opine, Opein. They are the largest kitchen manufacturer in China. They manufacture 1.8 million kitchens a year and about 750,000 closet organizing systems a year. So they're a big operation, 70, 80,000 employees. Big operation, super high quality, highly mechanized. And guess what? They're now looking for customers worldwide. Yes, there are tariffs to import that product into the US. There are not tariffs to import them into Canada. So we look at, various, where does this product make sense to use in our projects? Because we have development projects both in the US and Canada. We look at the global picture. But the important point here is that you've got a lot of suppliers from China that are now scouring the world, and they're willing to sell at a discount compared to what they were selling at before. So you can expect to see in construction materials, you can expect to see falling prices. Now, that may not happen all at once, but it is going to happen. We're seeing it. It is happening now. And we've gone through the last several years of rising construction costs, and we've been thinking, oh my goodness, how can it cost so much to build? We're going to look back on 2024 and we're going to say, boy, I wish I could build for 2024 prices. I can say that with absolute confidence. We're getting phone calls today from workers that last year would have been quoting $45 to $60 an hour. Today, I'm getting text messages every second day, folks looking for work saying, do you have anything for me? $30 an hour. It's a very different picture than it was a year ago. We're hearing of layoffs at the very front end of engineers, electrical engineers, civil engineers, folks that would have been busy working on new development projects. A lot of those guys and gals are being sent home because there's no work for them. So it's a very different picture than it was a year ago.
And yet you're confident that the construction pricing today will still be more advantageous than what has to be charged in the future for new development projects for new construction work. It's fascinating.
Absolutely. Absolutely. We see the opportunity. Look, when we're talking about new construction, one of the things that anytime you're doing any kind of project, whether it's a value add project on an existing building, there's still a construction component to it. If you're doing new construction like we are, it's the same issues. You're dealing with capital costs, you're dealing with, what's happening in rents, what's happening in construction costs. You have only a few levers that you can pull. And so, we want to make sure that you've got control of those levers. So we ourselves have seen, rising construction costs, obviously rising capital costs. And so we said, all right, well, if interest rates are going up, we need to pull cost out of these projects without necessarily sacrificing quality. I mean, I'm fresh back from a week in Europe, in Istanbul, attending a major builder expo. And it's really about understanding and knowing your numbers. I don't know if you can see this on the screen here. This is an example of an LVT floor. This is actually a sample from Home Depot. This is a luxury vinyl tile floor on a PVC and stone substrate. This is $4.28 a square foot at Home Depot. It's got a nice little rubber membrane on the bottom, so it provides some cushioning and some acoustic isolation. This is the equivalent product from Turkey. Same elastomer at the bottom. It's the same SPC core. And this is about $1 a square foot. And it's a very comparable product. This is a click floor. It goes together very nicely. There's all kinds of different finishes, various wood grain finishes. It's really quite a beautiful product. And when you multiply that over the square footage of an entire project and you see yourself saving, at least a couple of dollars a square foot, that moves the needle. It makes a difference. And you don't have to do anything particularly magical. Just got to get maybe a container load or two over across the Atlantic, and now you've saved a few dollars. So it's really about understanding those global supply chains, building those relationships. If you're just doing a single apartment, none of this is any help to you. You're going to have to buy locally because you just don't have the buying power. But if you are willing to pull together a few friends, or if you're willing to put a little bit of scale behind it, you can take advantage of some of the arbitrage that exists. Because let's face it, there's a number of countries out there that have been experiencing hyperinflation. Egypt is a good example. Turkey is a good example. And when you're buying in US dollars and you're paying in their local currency, you're able to purchase very high quality products for a fraction of what it would cost here in North America.
So we know we'll get to questions from the audience in full in a moment. And if you have good questions, please submit them in the chat. We can see your questions from YouTube, Facebook, LinkedIn. And if you are interested, we'll rank the questions according to priority in a moment. But before we move to any other predictions and then the questions from you, the audience, Victor, what's the name of the brand of that floor from Turkey?
Well, there's several. So this one is actually, the supplier is called Kermit. So we'll call it Kermit the Floor instead of Kermit the Frog. But there are several suppliers that we met over there, and there are several that we're evaluating, and we're sending the material takeoffs. There's many examples. I could talk about ceramic tile. I could talk about steel panel fencing, sandwich steel panels. It's so many different products that some of them we simply don't have here in North America. Some of them are very, superior quality in Europe. They're delivering a caliber of product that we just don't have here in North America. I would say if there was one that stands out for me, that would be interior doors. I visited a door manufacturer that is manufacturing European doors to US dimensions. They ship to the US. They're currently shipping about a container a week to their warehouse in Miami. And when I look at an American door by comparison, I go, oh my goodness, this is junk by comparison. I really don't want to buy a North American door ever again because they're just so bad compared to what I saw when I witnessed firsthand the factory visit and saw how they were put together and the assembly process and the actual assembly process in the field. One individual can put one of these European doors together, or can put like 15, 16 European doors together in a single day. And you cannot get that volume of install with with a North American door, not even close. So even from a labor standpoint, the savings are significant simply because of how the doors are put together. So it makes a big difference in understanding the whole construction process.
And for those of you out there who aren't working with subcontractors or general contractors on a daily basis, if you think about the labor and material pricing that goes into every single project, and you begin to weed your way into the line by line item breakdowns on how much your man hours cost and how much the managers of the man hours cost, you begin to realize to extract these savings out become exponentially greater over time because you're able to save on this project, which then allows your returns to be greater. And then it self perpetuates and you begin to build some velocity project after project. So, Victor, before we go to questions, any other predictions you would share with the audience?
Let's leave it at that. Let's go to the questions. And then if there's time at the end, we can probably bring in a couple more.
Very cool. So, first question is, how do you spend time on these subjects at the macroeconomic level and not get lost in the detail work of pulling on these threads when you know you have performance objectives to reach, you have businesses to run? How do you ensure that you're spending time appropriately following these big picture trends?
That's a great question. So we have a process internally within Y Street Capital where we actually at the beginning of each week, we actually as a team brainstorm the topics for the podcast. Now the topics fall into a few different categories. There are evergreen topics, things that are relatively timeless, that doesn't matter if I publish it this week or next, it's still going to be relevant. There are tie-ins to the news. So for example, if Federal Reserve Chairman Jerome Powell holds a press conference, I really need to report on that the next day. 3 weeks later is irrelevant. So those tie ins are important. And then we'll look at things that are happening in the environment. So if I want to shine a spotlight on a particular asset class, I will research Marcus and Millichap and Colliers and CBRE, and I will look at those market segment reports and see what I can pull out of that that's going to be relevant to the listening audience. The nice thing about this is that our listening audience are sophisticated. This is not the rookie audience at all. So I don't have to worry about spending time with, defining what is cap rate or any of these other things. I'm really focusing on things that are going to shine a spotlight on things that you might be thinking about, wondering about anyway, and maybe challenging some loosely held beliefs, evoke a bit of a curiosity response that says, oh, that's interesting. I'd like to learn more. And that's really all that I do. So I usually do that first thing in the morning, usually spend 15, 20 minutes each day doing that research if it's a topic that needs research. Oftentimes, if I get a listener question, that's another form of show that we do where we get a listener question and they present a particular specific problem that they're dealing with. That's very straightforward for me to respond to in a very timely manner.
Very cool. Randy asks that last summer you thought there would be many more bank failures in the fall, and there have been a few. Do you still believe there is the risk of larger bank failures in our future?
I do. I absolutely do. Because if you look at the loan book for a lot of the smaller regional banks, they, especially in commercial real estate, office in particular, some amount of retail, a fair bit of hospitality, there is distress in those segments of the market. And having the Federal Reserve or the FDIC telling those banks to go out and raise more capital works up to a point, because if you're the president of a small regional bank with a couple of billion in assets and you're going to the market looking for additional equity, what's the story? Please invest in my bank because I need it, otherwise I'm dead. That's not a compelling story. So it's got to be, a stronger story than that. There are, by some estimates, several hundred banks right now that are on the verge of teetering over. Let's not forget the BTFP, the Bank Term Funding Program, was set up to be a short-term stopgap in the wake of the Silicon Valley Bank, Signature Bank, and First Republic failures. And they continued to grow that. Now, some of that was interest rate arbitrage, where they were taking advantage of some free money by using the BTFP. But those balances did not decline over the course of the year. They continued to remain elevated despite the stigma that is associated with using a discount window like facility, because it's like putting a flashing red light on your forehead saying, I'm in trouble. And that we've seen the discount window hardly get used. And yet we know that there is distress in a number of the regional banks. That's very clear.
So Harry asks, backing up to the very beginning of one of your predictions, that understating inflation should increase gross domestic product.
Correct.
Yeah.
Exactly right. Yeah. So what happens is, so how do you calculate GDP? You calculate GDP by essentially adding up all the economic activity in the country. But in an inflationary environment, that number is going to increase every year. So if inflation is running at, let's say, 3%, that number is going GDP is going to increase by 3%. So and that's assuming the economy is not growing. So if you want to get to real GDP, you have to subtract the rate of inflation from your nominal GDP to get real GDP. Inflation is another one of those metrics that is manipulated. There's a lot of adjustments. There's hedonic adjustments. There are substitution adjustments. We could probably spend 30 minutes on that topic alone. And the Bureau of Labor and Statistics lays out in tremendous detail all of the adjustments that they make. So, for example, in inflation, when they compute the cost of housing, they don't actually compute the cost of housing. They do this thing called owner equivalent rent. So despite the fact that 65% of the homes in the nation are owner occupied, they pretend that you are renting your your home from yourself, taking money out of your left pocket, putting it in your right pocket as tenant and landlord simultaneously. And they're basing that rent number on what's happening in the rental market, which bears no resemblance to what's happening in the home ownership market. They're imputing a rent to you. And not only that, economic activity associated with that fictitious rent is being added to GDP, even though no money changed hands between your left pocket and your right pocket. It's being added to GDP. So it's inflating the amount of economic activity. It's understating what's happening in inflation. So there's just too many adjustments to be able to rely upon that number. There's some great ways of backing that out. There's a website called Shadow Stats by John Williams that recomputes all of these numbers using the same metrics that were in place back in 1972 before a lot of these adjustments got away from us. So if you go back and look at shadowstats.com, they reconstruct the numbers using the old methods without those adjustments. It'll give you a different perspective on what's happening in the economy.
The old math, I hear.
Yeah.
So, as we reach the end of our half an hour segment, to go back to true Main Street, right on the ground level of all that we experience as investors, as purchasers, as consumers and producers, what do you predict will happen with interest rates over the, let's maybe the short and medium term?
Interest rates will stay elevated until something breaks. I think that's been my belief. Many of the folks that I follow, Lacey Hunt, who used to be at the Federal Reserve, Danielle Martino Booth, who was at the Federal Reserve Bank of Dallas for 9 years, and several Fed insiders are repeatedly saying the same thing. I agree with them completely. So then the question is, what needs to break? One of the things that has been talked about is unemployment. Last year in the third quarter, they were saying, well, 4.1% unemployment was the threshold where we would switch from tightening policy to more accommodative monetary policy. They backed that down to 4.0. So now and our unemployment rate is a little over 3.8. It's like 3.84. You only need to get to 3.95 and a bit, so about 11 basis points before that rounds up to 4.0, and all of a sudden we're going to be into more accommodative monetary policy. You have to remember that the Fed and the federal government are actually at odds with one another. You have tightening monetary policy on one hand, and then you have very loose fiscal policy. The government spending money like drunken sailors. And so you've got the Fed trying to fight inflation, and then you've got the government who want to get reelected trying to stimulate the economy with fiscal policy and money printing. And so they're at odds with each other. They're trying to fight inflation with gasoline or fight a fire with gasoline. And no surprise, it's not working.
As we prepare to wrap up here, some of you may know that Victor does a daily podcast, the Real Estate Espresso podcast, covering subjects like this, subjects for investors, for the producers in an economy to be able to take in data at a short 5 minute per day segment to be able to learn and apply some of this info. We have started to curate out of his 2,300 episodes now, 2,301 as of yesterday. Is that right?
That's right.
We've started to curate that list into more focused segments so that you don't have to listen to 2,300 times 5 minutes in order to get your insight that you're looking for. And so if you look into the chat, you can find some of those links so that we can provide with you some of the curated approaches that we've assembled together of good podcasts that have good material. So, Victor, leave us with another idea. What's another prediction that you're confident in for the next period?
So we are going through a period right now where there's what's called reversion to the mean. We've gone through a period right now, and this is a little bit further out in time. I can't tell you exactly when this prediction will come true, but we've seen a lot of geopolitical instability. We are familiar with this concept called nearshoring, where instead of buying products from overseas, we're seeing domestic manufacturing being set up in the United States, in Canada, a lot of it along the US Mexico border. There's Chinese companies opening factories in Mexico. One company is producing 3,000 sofas a day and selling them to Wayfair and Target. And it's a Chinese company in Mexico, in Monterrey. And so if there was already excess manufacturing capacity in China, well, now we're adding more manufacturing capacity domestically. and in Hungary and in Romania and many other places all over the world, so that instead of getting just in time manufacturing, we're getting just in case manufacturing. So we have these secure alternate sources of supply. What that ultimately means is that we are facing global excess manufacturing capacity. That will not last forever. That will at some point get rationalized. I don't know when, but it will not persist forever. At a certain point, the folks that own these facilities will say, I have way too much capacity. Which one am I going to shut down? So we're going to see a retrenchment in manufacturing. I don't know where, I don't know when, but stay tuned for it because it's going to happen.
Fascinating. Well, if you would like to hear more like this, drop into the comments in whatever platform you're listening into, fill out our form, and you can gather some of those curated lists of podcasts that hit on subjects like what we've discussed. Victor, thank you so much for your time. When are we doing this again?
We're going to do these monthly. Maybe we'll make them even more frequent, but thank you for joining. It's always fun to connect and talk. And we love to get listener questions on the podcast. So if you've got questions you'd like me to answer live on the air, send your questions directly to me at victorjm.com. Happy to answer your questions. I usually turn those around within a day or two. So happy to answer your questions live on the air.
Thank you all for joining. Have a great weekend. And we will see you at the first Friday of every month, 5 p.m. Eastern Time. Talk to you soon.
Bye for now.